So far in this unit, we've been thinking about the processes of long-run economic growth, and this just determines how output or income levels change over time. Because our focus has been very much on the long run, we've totally abstracted from all the shocks and the cycles that impact the economy in the short run. Our measure of long-run output is therefore often referred to as trend gross domestic product or potential gross domestic product, because it's basically the level of output that is obtained when things like the labour market and the market for capital are all in equilibrium. So whenever we look at a position in the economy, it's balanced. There's no positions of excess demand or excess supply anywhere. In our next teaching block, our focus is going to be on the short-run level of output, and this is going to look at the cyclical movements in gross domestic product around this long-run trend or potential level. Before we do so, there are three important concepts I'd like to introduce to you now. The first is something called the output gap, which is a measure of how actual output or actual GDP deviates from this long-run potential or trend level. So this is very much a cyclical measure of the economy. Second, there's something called Okun's law, which describes the relationship between the output gap and the rate of unemployment in an economy. And third and finally, there's something called the Phillips curve, which describes the relationship between the output gap and the rate of inflation, or the rate at which prices are changing in an economy. Let's start off our thinking about the short run by looking specifically at the labour market. There are two main factors that determine the rate of unemployment in an economy. The first is the economic cycle. So this is the cyclical or the short-run component of unemployment. And this just reflects short-run changes in demand. So we'd expect unemployment to rise in recessions and fall in booms. The second is the structural component of unemployment, and this is longer term and reflects fundamental imbalances in the demand and supply of certain types of labour. And this longer run unemployment persists, even as the effects of the business or economic cycle are taken out. This long run component of unemployment is often described by different names, the equilibrium rate, the natural rate, but the one I want to use is called the NAIRU, or the non-accelerating inflation rate of unemployment, because this is considered to be the unemployment rate that is consistent with the trend or potential level of output or GDP in an economy. The NAIRU is also consistent with stable wages and prices in an economy, because essentially the labour market is in equilibrium, so there's no pressure on wages to change, and because wages feed into prices, there's therefore no pressure on prices to change. The NAIRU itself reflects a long-run equilibrium position in the labour market, and it's basically determined as a bargain between workers and employers over the level of something we call real wages. So that's the nominal or cash wage divided by the price level, and what it tells us is just how much you can buy given your level of wages. The simple bargaining framework we use to determine the NAIRU suggests that workers basically set the level of cash wages, so they're responsible for wage setting, and firms, given those level of wages, then set prices, so they're responsible for price setting. And if we take the two together, wage setting and price setting, we are therefore determining the level of real wages in the economy. And as we shall see, this also determines the equilibrium rate of unemployment as well. There are two factors that determine the real wage that workers push for. The unemployment rate plays a very important role, because as this increases, workers have a tendency to moderate their wage demands. So basically they become less ambitious because they don't want to price themselves out of employment. The higher the unemployment rate, the more cautious workers are in the wage bargain. The second set of factors, which I've grouped together and called Z, are basically things that influence the relative power of workers in this wage bargain via the employers. These might include the power of trade unions, or things that raise the opportunity cost of working. For example, if unemployment benefits are incredibly generous, then the cost of being unemployed is basically lower. So therefore, workers would be more ambitious in pushing for higher wage demands. The bargain real wage is basically the level of real wage that workers push for at each rate of unemployment. And as we have seen, as the unemployment rate increases, this level of aspiration falls. So we've basically got an inverse relationship between the real wage that workers want and the rate of unemployment they face. Remember, workers are primarily responsible for just setting the nominal wage here. So they take the price level as given and they set the nominal wage in order to achieve their target or aspirational real wage. The other side of the labour market are firms, and as we said, we assume that these set the level of prices in the economy. Now, prices are just set as a markup over costs, and the size of that markup basically is determined by a parameter I've called mu, and this just reflects the amount of competition in the economy. If there's lots of competition between firms, then obviously that markup is going to be much lower. If there's not that much competition, then of course firms would be able to exploit any market power they have and basically set a higher markup or profit margin over the costs they face. So that markup is probably inversely related to the amount of competition that exists in the economy. Labour costs themselves are basically given as the ratio of nominal wages and labour productivity. As cash wages go up, the cost of hiring people also goes up. If labour productivity goes up, then labour costs are actually falling. And this is because if everybody is more productive, then we don't need to hire so many people in order to produce a given level of output. So our labour costs, in essence, fall. You'll see from the price setting relationship that firms use that this can be rearranged so that it's expressed in terms of the real wage. So we've got W over P on the left hand side. And this gives us what we call the feasible real wage. So this is the level of real wages that firms can afford to pay their workers given the level of labour productivity and the amount of competition they face in their product markets. When we plot this, the level of the feasible real wage is independent of the rate of unemployment. The rate of unemployment has no effect upon this feasible real wage level. The only two things that matter are the level of labour productivity and the amount of competition given by the markup parameter mu. We can now put everything together to see how the equilibrium position in the labour market is determined. And this is basically going to be where the bargain real wage is equal to the feasible real wage. At this point, the real wage that workers push for is consistent with the real wage that firms can afford to pay their workers given the level of labour productivity and the amount of competition they have. Incidentally, as we will see, this equilibrium rate of unemployment is where wages and prices are also stable. So that is basically why it is called the NAIRU, or the non-accelerating inflation rate of unemployment. At that rate of unemployment U star, there is no pressure on wages or prices in this economy to accelerate or decelerate. Think about what might happen if the unemployment rate was to fall below this equilibrium rate, or NAIRU. Suppose actual unemployment was U2, and this is compared to the NAIRU, or the equilibrium rate of unemployment, at U1. Now, because unemployment is lower, workers become more ambitious in terms of their real wage demands, and therefore they increase the nominal wage in the bargain in order to try and achieve a higher real wage. And in doing so, we'll notice that the bargain real wage now exceeds the feasible real wage. So what would happen? Well, the first thing that would happen is that we might see an acceleration in wages and prices. That higher nominal wage that workers have pushed for increases labour costs. But because prices are set as a markup on these labour costs, higher nominal wages will then feed into prices. But then as prices go up, that will then reduce the value of the real wage because prices are rising in line with wages. So therefore, workers would then have to push for another increase in the nominal wage in order to try and get the real wage increase that they're hoping for. So what we essentially see here is a wage price cycle where one feeds into the other. And as long as the unemployment rate is below the NAIRU, or the equilibrium rate of unemployment, that wage price spiral will continue and we'd see an acceleration in the rate of inflation. Of course, what we'd also expect to happen is that as wages go up, the cost of hiring people becomes more expensive. So therefore we'd expect firms to cut employment, and in doing so unemployment would rise and the economy would also move back towards its NAIRU, or its equilibrium rate of unemployment, which is given by U1. What this model does is it gives us a simple relationship between the unemployment rate and the rate of inflation in an economy. If the unemployment rate is below the NAIRU, or the equilibrium rate, then wages and prices spiral upwards and the rate of inflation in the economy accelerates. Vice versa, if the unemployment rate is above the equilibrium rate, or the NAIRU, then we see the opposite occurring. Wages and prices start spiraling downwards as workers try to basically price themselves back into employment by reducing the nominal wage that they push for, and then this would then feed into prices and we sort of see the price inflation in the economy decelerating. Here is some data I pulled from the OECD website, and it shows an estimate of the UK non-accelerating inflation rate of unemployment, or the NAIRU, and the actual rate of unemployment. You'll notice that the actual unemployment rate moves cyclically around the NAIRU. The chart on the right hand side shows the cyclical component of unemployment, that is the difference between the actual and the NAIRU rates of unemployment. You'll also notice that the NAIRU itself isn't stable over time. In the UK, it has actually had a tendency to drift downwards over the last 3 decades, and this suggests that the economy can maintain lower unemployment rates without generating an increase in the inflation rate. Remember, the NAIRU itself could fall if any of the parameters in our model also change. So if the bargaining power of workers falls, if product markets become more competitive, or if labour productivity rises, any of these factors would actually reduce the equilibrium rate of unemployment, or the NAIRU, in the economy. So there's no reason why the NAIRU itself has to be constant over time. So how does all of this relate to the potential or trend level of output in the economy? So remember at the outset, we said this is the level of output, or GDP, consistent with the NAIRU in the labour market. And it's easy to ascertain in just a series of simple steps. First of all, the labour force in the economy consists of those who are employed and those who are unemployed. Employment is basically the proportion of the labour force that are not unemployed. So if small u is the unemployment rate, then the proportion not unemployed is just basically 1 minus this small u. Finally, output is determined by a production function where we've got inputs of capital and labour, and then we've got total factor productivity that tells us how efficiently these inputs can be used. Now, the potential level of output is basically the level of output where the unemployment rate is equal to its NAIRU. Let's look at this graphically. In panel A, we've basically derived the equilibrium rate of unemployment, or the NAIRU, and this is just where the feasible real wage and the bargain real wage are consistent with each other. Given this rate of unemployment, the level of employment is basically just 1 minus the proportion who are unemployed multiplied by the size of the workforce, and this is basically shown in panel B. So given an equilibrium unemployment rate and the size of the labour force, we can work out how many people are in employment. If we then take this level of employment, we can then combine it with capital in our production function, and we can see how productive it is as well using total factor productivity to determine the level of output in the economy. And this is shown in panel C. And then finally, in panel D, we can see that basically the potential level of output, which is consistent with the rate of unemployment being equal to the NERU. Now we can basically start to put all of this analysis together to understand how the short run in the economy relates to the long run. So short run output is the difference between actual and potential output, and this is the cyclical component of output, or GDP. If short run output is positive, actual output exceeds trend or potential output. If short run output is negative, then actual output is lower than this trend or potential level of output. The output gap is basically short run or cyclical output as a proportion of the trend or potential level of output. If the short run output or the output gap is positive, then this implies that the unemployment rate is lower than the NERU, and as we've seen, this basically means that inflation in the economy is accelerating because the lower unemployment rate pushes up wages, which pushes up prices, and so on. So a period of cyclically strong output would be associated with lower unemployment rates and rising inflation. If short-run output or the output gap is negative, then this implies that the unemployment rate is above the NERU and inflation is decelerating because moderation in wage demands then feeds through into prices, etc., and the rate of inflation would be falling. So a period of cyclically weak output in our economy would be associated with a higher rate of unemployment and a slowing rate of inflation. Using data published by the OECD, we can plot actual gross domestic product in the UK against an estimate of potential gross domestic product. The output gap in the right-hand side chart therefore shows cyclical movements in the UK economy over the last 3 decades. What we can see is that there is a relationship between cyclical movements in gross domestic product and the unemployment rate, and this relationship is known as Okun's law. Basically, whenever short-run output or the output gap is positive, then the unemployment rate will be lower than the NERU. And when short-run output or the output gap is negative, the unemployment rate will exceed the NERU. The chart on the left-hand side shows some data for the UK demonstrating how cyclical movements in GDP and the labour market do in fact coincide. The Phillips curve gives us a hypothesized relationship between the output gap and changes in the rate of inflation in the economy, and we'd expect a positive association between these two things. When the output gap is positive, the unemployment rate is lower than the NERU, and here we'd be expecting wages to increase, that to feed through into prices, and therefore the inflation rate to be accelerating. When the output gap is negative, we know that unemployment is higher than the NERU, and therefore the inflation rate in the economy would be falling. Our focus so far in this unit has been about trying to explain how the potential or trend level of output changes over time, which we have linked to total factor productivity or the accumulation of knowledge, technology, ideas, etc. The short run describes how the economy may deviate from this long run path and how these deviations might be corrected by the actions of policymakers. We know that the economy in the short run is being consistently hit by shocks, which may cause cycles in output and inflation. Monetary and fiscal policies are the two main arms or the two main levers that governments and policymakers use to try and counteract these shocks and basically keep the economy on an even keel. We also know that cyclical movements in GDP are associated with movements in the inflation rate and the unemployment rate through Phillips curve and Okun's law respectively. It is obvious why we should care about long-run growth, because the level of trend or potential output in the economy affects living standards and the prosperity of nations. However, the short run is also very important because cyclical movements in the economy can last for many years, and fluctuations in unemployment and inflation can have significant welfare effects on the citizens of a country. Also, what happens in the short run may also affect the long run. We can think of capital investment as being a decision that's made in the short run, but of course has long run consequences on economic growth and the level of output. So the short run and the long run are intertwined and related to each other. My job is now essentially done. I've spent an entire teaching block telling you about long run economic growth and why it is so important. I'm now leaving it up to EY to basically do the same thing for the short run performance of the economy. So I have nothing else to do now apart from to wish you all a happy new year, and I'll see many of you back in Portsmouth in a couple of weeks' time.